Welcome to the NAIOP Southern Nevada Breakfast Program. I'm Matthew Hoyt, and I have the privilege of serving as your chapter president this year. Good morning to everyone here at the Orleans and everyone joining by Zoom. For all of you that are here in the room, you'll find notepads at your tables. Please write down any questions you have during the program, and Dan Tuntland on the Programs Committee will collect them for our Q&A session from 9 o'clock to 9:15. Today we have some very special guests in our audience. I'd like to recognize the elected officials in attendance today. Please stand and be recognized when I call your name. City of Las Vegas Councilwoman Chandra Summers Armstrong. City of North Las Vegas Councilman Isaac Barone. City of North Las Vegas Councilwoman Ruth Garcia Anderson. City of North Las Vegas Mayor Pamela Goins Brown. Henderson Councilwoman Monica Larson. And Henderson Mayor Michelle Romero. We also want to recognize our UNLV students attending today. I'm told we have 11 students in the room this morning. If you're a student, please stand and welcome to NAIOP. Everyone, please take time to introduce yourself to the students in the room today. They'll be wearing green ribbons on their name tag. They are the future of our industry. This year, NAIOP's National Conference, CRE Converge, is in Toronto, Ontario, Canada from September 8th to 10th. If you guys recall, this was here in Las Vegas last year. If you want to get connected with the entire commercial real estate community, industrial, office, mixed use, multifamily, and more, with networking, education, tours, and special events, please register at creconverge.org. Let's take a moment to honor our President's Circle sponsors. They're a critical component to the success of our NAIOP chapter. This year we have 5 platinum sponsors. A special thank you to each one. City of North Las Vegas, a new platinum sponsor this year. Thank you. Cox Business, which has supported our chapter for 21 years. Gatsky Commercial, now known as Lincoln Gatsky Commercial, since 2022. Martin Harris Construction since 2001. And Schnitzer Properties since 2000. Thank you to our platinum level sponsors. We also want to thank our 9 gold level sponsors: Burke Construction Group, Inc., Clark County Community and Economic Development, EBS Realty Partners, Heller Companies, LLC, Howard Hughes, Kimley Horn and Associates, Majestic Realty Company, Prologis, Southern Nevada Water Authority, and Unforgettable Coatings. Thank you to our gold level President's Circle sponsors. And now please check out the screen as we recognize our silver sponsors, our bronze sponsors, and our copper level President's Circle sponsors. Thank you to all of our President's Circle sponsors. I'm happy to report that support from our President's Circle sponsors reached an all-time high in 2025. If you're not currently a President's Circle sponsor, you still can be. It's still a great time to join. If you're interested, please stop by the registration table for a package, or you can talk to myself, Lisa Brady at Prologis, Katrina, or Jonna. Why don't we get started with the committee announcements? Can I have representatives from Bus Tour, Community Service, Spotlight, and Membership?
Good morning, everyone. I'm Tyce O'Neill with CBRE. On your tables, you'll see postcards for this year's bus tour event. I'm searching for the golden ticket. We do have room for one more sponsorship available. One of the 4 rooms. So if you're interested, please reach out to Morgan Elson or myself. Thank you.
Good morning, everyone. I'm Shawn Brunswick,
And I'm Megan McInerney.
and we'd like to thank everyone who attended the bowling tournament and participated in the raffle prize drawings. And we were able to raise over $4,700. Yay! And I don't know if you know this, but all of the proceeds goes towards supporting our community service initiatives for the rest of this year and through 2026.
And this week, we just wrapped the Hollingsworth Elementary Back to School Drive that I know a ton of you all supported. We donated over thousands of school supplies to their STEAM Academy, as well as had 35 volunteers read to all of the classrooms. So it was such a fun event. There were a ton of members there, and I really urge you all to get involved with the rest of our initiatives throughout the end of the year. So thank you.
Thank you.
Good morning, everybody. Gaetana Cafasso with Burke Construction here on behalf of the Spotlight Awards. So mark your calendars. We have the 29th Annual Spotlight Awards event taking place on Saturday, February 28th at Red Rock Casino. This year's theme is NAIOP on Broadway. So keep an eye out for sponsorships and the intent to enter for projects. Thanks.
Good morning. My name is Tanya Carrasco with Wright Engineers. On behalf of the membership committee, I'd like to invite you all to our social event of the year on Thursday, September 25th at Chicken and Pickle. If you're not confident in your pickleball skills, don't worry. We won't be playing, only mingling. So please, if you're a member or non-member, join us. Because you are all here in attendance, you all have the chance to get free registration for the social event of the year. So please check under your chair now. If you have a flyer taped underneath your chair, congratulations. Anyone? No? I was told it was taped. Did anybody find a flyer taped under their chair? Woo! Ryan, maybe you can give it to someone, but congratulations. We still have sponsorships available, so if you'd like to sponsor the event, just let someone know on the membership committee or one of our NAIOP team members. Thank you.
That's a fun way to wake everybody up. Give them a free shot at a ticket to the social event. New member recognition. We like to recognize our new members in the room. I'm excited to say we have 27 new members this month, which is huge. If you're a new member, please stand and welcome to NAIOP. If you see a red ribbon on the name tags, please be sure to welcome our new members. I'm happy to report that we're now ranked as the 8th largest NAIOP chapter, currently 764 members strong. I did see a report yesterday or the day before that we were about one member off from being ranked 7th. So let's get to 7th by next month. Really excited about that. A quick thank you to our membership committee for continuing to tout the value of NAIOP membership. If you've never been a member, now's the time to join. With over 300 people in the room today, and continued record attendance at our events. I've been saying this since my first time at the podium back in December. Our chapter truly is the best. It's because of all your continued attendance and commitment to our NAIOP programs that we are the place to network and get informed. I'm no longer surprised by the excellent turnout at our events. I just truly believe the benefits of getting involved and being a NAIOP member have never been better. There are a few ways to join. You can stop at the registration table and ask for an application. You can visit our website to join online. You can call the NAIOP office, or you can reach out to anyone with a membership committee ribbon on their name tag today. We'd also like to thank our 2025 breakfast meeting sponsors: American Nevada Realty, Carpenter Sellers Delgado Architects, City of North Las Vegas, Cox Business, Martin Harris Construction, NV Energy, Panattoni Development Company, Schnitzer Properties, Southern Nevada Water Authority, the Whiting Turner Contracting Company, and our Wi-Fi sponsor, Gatsky Commercial, now known as Lincoln Gatsky Commercial. Thank you to our breakfast meeting sponsors. And a special thank you to this morning's meeting sponsor, Panetone Development Company, who is also a bronze level President's Circle sponsor. I'd like to call Philip Dunning, partner, to the stage, who is also the treasurer of our board of directors.
Thank you, Matt. From Panetone, we appreciate this opportunity to sponsor the breakfast event this morning. It's incredible to look out and see so many fresh faces, new people come into the industry, and a lot of friends that I've made over the years. And this is, to me, the premier networking and education and support, especially on the government affairs side of our industry. And NAIOP has an incredible voice, not just locally at the state level, but also nationally. So a little bit about Panetone. We are a privately held industrial developer that has a presence across the globe. We have offices across the United States with coverage across almost every state in our country. We have Canada. Mexico's a new expansion for us. We are probably even a bigger company in Europe. We've recently also expanded into India and Saudi Arabia. So when you think of Panetone, understand that it is an incredible sized company with a lot of reach, but also with a local presence, and just an incredible honor to work with Panetone as a partner, and look forward to doing business with a lot of people in this room. I see a lot of vendors that we work with, a lot of associates, and I'm just honored to be here today, so thank you for that.
Thanks again to Phil and Panetone Development Company for sponsoring today's breakfast. As you know, our programs committee has been putting out the best programs in the business. One of the reasons our programs are so outstanding is the audience participation. This is one last reminder, we have a Q&A session at the end of the program from 9 o'clock to 9:15 for our in-person attendees. There's pens and papers at your tables which will be collected. So let's segue from that into today's program. Today's program is titled Building Tomorrow, the Future of Multifamily and Workforce Housing in Southern Nevada. I'm pleased to introduce our moderator, Adam Schmidt. Adam is Vice President with CBRE in their Las Vegas Multifamily Capital Markets Group, specializing in the sale of institutional quality multifamily communities across Southern Nevada. Since joining the team in 2015, Adam has played a key role in the successful disposition of more than $5.6 billion in multifamily transactions, leveraging his deep market insight and analytical expertise to drive value for both private and institutional clients. With a strong foundation in market research, underwriting, and investment analysis, Adam brings a data-driven approach to every assignment. He works closely with investors throughout the full transaction cycle, from asset positioning to pricing strategy to marketing execution and closing, ensuring clients receive seamless service and strategic guidance. Before joining CBRE, Adam gained valuable experience as a market researcher at Crescent Communities, a national multifamily developer, and in the corporate partnerships division of UFC. Adam is also a UNLV alum. Go Rebels. Please join me in welcoming Adam to the stage.
Testing. Can you hear me? Hi, everyone. Good morning. Good morning. Well, thank you for coming out this morning. I appreciate you all taking an interest in multifamily. They say there's about 300 of you here in person, which is a near record number, and they say there's over 1,000 people on the Zoom link. So that's pretty impressive attendance, I would say. There's actually just like 50 people on the Zoom, so. But wanted to hype it up. So we're going to get into the ins and outs of the multifamily market today, development, acquisitions, research. So enough of me. Let's welcome up my panelists here. If you guys want to come to the stage, I'll introduce you after you sit down. You can clap for them too if you'd like. So to my left, we have Ed Aloe, the CEO and founder of CALCAP Real Estate Advisors. Ed has been active here in the market on the acquisition side, predominantly value add of existing product. So Ed will help us get into that part of the conversation on multifamily investment. To his left is Dr. Shawn McCoy, director of the Leeds Center for Real Estate at UNLV, where he's also an associate professor there. In my short time of getting to know Shawn in preparation of this panel, I've never met somebody who gets so excited about numbers. So he'll get into that aspect of the business as well. And all the way down there, we have Josh Nelson, Chief Investment Officer over at the Kalita Group. Kalita is one of the most prominent multifamily developers here in the market. If you're driving around town and you see those big, beautiful Elysian branded buildings, that is Josh and his company. So I think we have a really good couple silos here in our business to make the conversation pretty educational to you all. And at the very least, you all get powdered eggs. So we'll see where this goes. So starting with you, Shawn, let's talk about just a good backdrop of multifamily fundamentals. I think the biggest hurdle that we're facing today is supply. Right, so to put some baseline to it, the 20-year average for multifamily deliveries in Las Vegas is about 3,500 units per year. In 2023, we saw 7,000, so twice the 20-year average. Last year, we saw about 5,300, and this year, we're probably seeing a similar figure, though some of that may spill into the first quarter of next year. So, Shawn, ultimately, how is the supply in today's market ultimately affecting the fundamentals of the market as it relates to occupancy and rents?
Good question, and we have two markets. The market you're seeing right now, what we're going to see in about 2 years. Some baselines. If you look across all market rate multifamily property, the average unit right now renting for about $1,477 per month. And this is a sort of interesting number because it's down about 1.2% year over year. And if you look at peak COVID rates that hit in 2022, we're actually down about 4%. So if you take everything out of the COVID era and just look at how multifamily trended leading up to COVID, we're actually lower now than we were projected to be had COVID never actually happened. So what's going on and why? And there's really two sides to every sort of price story, the demand side and the supply side. Is demand dropping? And the answer is not really. So if you look at absorption stats that have been occurring, they've been fairly stable. And market absorption for multifamily is projected, if anything, to rise going into the next quarter. So demand, I don't really think is part of what's explaining the price drops that you're seeing. But the smoking gun, the vacancy rate. Vacancy rate, at least unstabilized vacancy, is up, and the concession rate is up. And if you look at some of these maps, I'll be here shortly, you see concessions rising in areas where vacancy is rising, which to an economist says, well, let's look at the supply side. And supply did have a notable shift in the past 4 years. For the past 4 years, 18,489 multifamily property units were dropped on the market, which is 43% more than what you would have seen in the market if you shifted back the previous 4 years, 2017, 2021. But there is a catch, and the catch is that while that supply shift was up about 40%, construction right now is down by about 43%. So net deliveries and deliveries going into tomorrow's market are probably going to tank. Mm-hmm. And when they do, you combine that with potential tailwinds from a single-family residential, this is going to put upward pressure on rents, and why most economists, at least multi-housing economists, are projecting rents to go up in 2026, 2027.
I think that's a good point. We're seeing starts as low as they've been since 2013. So once we're through what this wave of supply, for lack of a better term, I think the later half of 26 and mostly all of 27 is going to be pretty dormant from a supply standpoint. And you talk about the relative unaffordability of the single-family side and largely underbuilt on the single-family side. The delta between renting and owning has never been wider. And that's in every market, but especially in Las Vegas where you have a higher propensity to rent just naturally. So sticking with you, Shawn, you did a really interesting study on the true affordability of market rate apartments for our workforce population. I think that garners a lot of negative headlines, but you dug through the headlines to be able to figure out, what is the actual affordability for our population for multifamily.
That's right. And this story needs to go back about 6 months prior to that study. In 2022, the United States Census ranked Nevada the second highest cost burden state for renters in the United States. And for anyone that works with census data, the first thing you need to know is you need to question everything. Everything's a sample, everything's a survey. And our team at UNLV was like, well, look, it's a sample, it's a survey. Let's sort of take a really deep dive and find out what's really behind that number. And we discovered something that I don't think many people really take stock of. The cost burden, by the way, represents the proportion of your income that goes to housing and rent. And again, renter cost burden was peaking in 2022. When we dug into the data, what we found was that the way the census produces this estimate, they take a survey of all renter households across the state. That means market rate multifamily. It also includes all single family rentals in the market that go into the cost burden estimate. And guess what happened in 2022? The share of single family rentals in Nevada also reached an all-time high, which are higher cost burden rental markets. And that was driven by and large by a rise in investor purchases of single family homes. So the punchline here is when we talk about cost burden, in principle, in theory, even if apartment rates just never changed, but the mere share of single family rentals coming onto the sample went up, which they did, that could elevate that cost burden metric, which we believe was a principal factor actually driving that finding. A little bit misleading. In fact, frankly, it's quite misleading. So while we were doing this, though, we discovered a new demographic shift. You can look this up from Brookings Institution, Cato Institute, economists, demographers worldwide, the rise of the global middle class, which is rising at a rate faster and also in share than has ever happened before over the entire course of human history, right now. And when we're talking about the rise of the global middle class, what we're really talking about is the rise of the share of demographics in what we call the middle income segment. Households between 80 and 120% of a county's sort of average income level. And guess what workforce housing is? Workforce housing is housing that is precisely affordable to households in that middle income segment, which all of a sudden makes conversations about workforce housing a priority number one. But going back to the census isn't apartments. So if we're thinking about housing policy, the first thing you want to do in terms of addressing affordability, the first thing you want to do is ask, like, what do we actually have to work with? What are we doing right now that can deliver affordable market rate units to people in the largest, fastest, biggest growing segment in the world? And so what we did is we moved away from census products and surveys and went to real data. We collected data from CoStar, which tracked the apartment rents on the near universe of all market rate multifamily property across southern Nevada. And a finding right now coming out of the Lead Institute, which is the first published finding of its kind, is something that is shaking the housing economics profession as we know it. Looking at that particular data set, taking that middle income housing segment, everything from 80% to 120% around that average income in a city, at the low end of that segment, 60 to 74% of market rate multifamily properties are affordable by every measure in the book to households in that segment. Now, if you go to the top end of the middle income segment, the top end of the workforce population segment, it's a whopping 96 to 97% of those units, which is not what you would have expected, but it's what we certainly found, and the study is available for you to read. So let me tie this up by telling you why this very well may be the singular greatest, most important thing we should be thinking about in Nevada. And it comes down to population growth. Over the next 10 years, this video is being recorded. We can go back, and I'm hoping I'm wrong, but maybe we'll be right. over the next 10 years, 388,000 people will be moving to this metro. And if you convert that to households, it's about 145,000 households. And if you look at the share that belong to that workforce housing segment, that's about 50,000 households that will join that workforce middle income segment that will need market rate affordable property just to sustain the economy, which equates to about, starting today, about 5,000 more market rate units just for that segment each and every year, now until the 10-year horizon, plus all the remaining, say, 12, 13,000 units a year for the remaining population shift, in addition to all the remaining requisite amount of commercial development so that we can attract new business and employers so that when that segment actually comes to the market, they have a place to work. Does that answer your question?
I think so. We could probably just wrap it up from here. I told you he likes numbers. Ed, getting to your...
Whatever Shawn said is fine.
Yeah, okay. Just skip Ed, questions? Getting into everything that Shawn just said about affordability and the demographic shifts and population and things like that. You're not just in Nevada within
Correct.
your company. You're across 16 states across the United States. How does the notion of affordability play into your overall, one, target market data for a market you want to invest in, and also the ultimate value add plan of the properties in that market?
Yeah, so I started my company in 2008, so right during the depths of the GFC, for those of you who remember that period. And so we started investing in Las Vegas around 2012. So it was highly distressed market, so been through a few cycles here in town. I was telling Shawn earlier, we bought our last REO properties here in 2015, which is hard to believe. Like, it was 7 years into the cycle, and there was still distress. So now, we're seeing kind of a different issue. What Shawn touched on earlier is supply, right? So multifamily has been hit nationally, not just Vegas is a microcosm of what's happening across the country in terms of this inundation of supply. So all the great hot markets like the Las Vegas, Austin's, Dallas, Houston, Phoenix, they were all great, hot, growing markets, which is where we like to invest, right? We look for employment growth and job growth. And so because of that, developers rushed in over the last 5 years, and we've seen record supply. But that record supply, to Shawn's point, it's not structural, right? It's a cyclical supply issue. And the demand, and everyone is saying like, gosh, there's so much supply, and there is. But the demand portion has been so resilient. I think it shocked a lot of economists at how resilient it really has been. And so, we invest in workforce that's sort of 60 to 120 AMI, right? Area median income, if you guys understand how the AMI works. And so it's that renter, it's that working class renter primarily. And we still see Vegas, compared to a lot of other markets, Adam, it's still relatively affordable in terms of cost and rents. It's still an affordable city in that nature. And it's a growing city with now, much more diverse economy, with pro sports teams and everything that you guys are doing here, which has been great, compared to, when we first started investing here a while back. Yeah. So, we're bullish on Vegas. I mean, it's definitely going through a cyclical period right now, because multifamily kind of got hit with a few things, right? So in Q2 of 22, I think was sort of the peak of the market, or Q1 22 call it was probably the peak of the market. And then interest rates went up, right? And so that all of a sudden just tanked everything, including pipeline, people that were willing to sell. All of a sudden there was a gap between buyers and sellers, as you know. And so it really just kind of shut down the market. At the same time, places like Vegas that came off of COVID, where there was a bunch of stimulus and landlords were getting rent paid by governments, that all dried up. So it kind of washed out a lot of residents that couldn't afford anymore. So we're seeing, the one negative thing we're seeing here is a lot more fraud from residents who are applying to rent from us. I would say our fraud is probably 10%-ish of new applicants, if you can believe that.
It used to be a lot worse.
Yeah, and now, as you probably know, you can literally go online to TikTok and some social media sites and buy a complete renter's fake Social Security, trade lines, W-2s, employment, whole package for like $650.
Yeah, yeah.
And so we really had to be diligent and got good at detecting fraud. And a lot of tenants are lying because they have evictions, right?
Right.
Because of what we went through, and so.
So, yeah, touching back on supply, and we'll get to Josh here on this question, because he's, I wouldn't want to say a contributor to it, but definitely a developer. And you know, talking,
It's your fault.
I complimented your
making housing
properties
affordable
earlier. I
again.
said they're beautiful. You know, looking at the supply in Vegas relative to their Sunbelt markets, I think that the story to tell here is, though we are in a wave of new supply, the total supply to existing inventory in the market is only about 3 to 4%. Whereas in Phoenix, Dallas, Austin, you're talking 10, 11, 12%. So you're seeing a lot higher rent declines in those markets where supply is a larger percentage of existing inventory. But on rent declines and compressions and concessions, you're obviously active in the market, both on stabilized product, but also in lease up today. What does that look like for you across your portfolio here today as far as operations are going?
I think what's interesting about hearing some of the statistics that you were referring to today is there's a difference today between, call it, gross rents and net rents. So right now, within certain pockets of the market that had the greatest amount of supply, there's been just a battle out there for concessing to essentially buy occupancy. And we're literally seeing, we build some of the best product in the market, if I do say so myself, but it's not designed by me, so I don't want to take all the credit. But we are competing literally on a block-by-block basis with all the concessions that other competing product that's recently been delivered is offering. And in 2022, there's so much capital in the market that really believed in the growth story and the population growth and the net migration away from the Midwest to the southwestern states, that a lot of people were willing to kind of underwrite through some of that kind of softness within the actual financials. And today, everyone's just realizes that the softness is real and you can't just pretend that this isn't going to exist. So a lot of people are looking at the supply-demand balance within the next couple of years, and they're seeing the same things that Shawn's mentioned before, that there's less capital availability for multifamily today based on sort of some of that softness of the market. And it's just very important for us as a sort of a local community to realize that some of the cyclicality in the market is based on capital availability that just doesn't necessarily exist today. But there are things that we can do to make it easier for developers to build product, which ultimately will allow for more supply of nice product for our community to effectively live in. So I think some of the things that when the market's hot, there's a ton of capital that can ultimately fund these projects despite what's kind of happening within the local economy. But the second attribute is policy around density, policy around certain considerations regarding where your trash bins can be located. All of these things can actually help the viability of new multifamily product within the market.
Well, that's my next topic. It's a great segue. Let's talk about the viability of on your side of the development equation. I think there's two major headwinds today that people are starting to talk about a bit more. There's probably a lot more headwinds beyond that, but we only have 26 more minutes. So talking about land availability, privately owned land where you're able to actually go and buy and build. Southern Nevada is 86% federally owned through the BLM or from the federal government itself. So you're finding it to be, you have this sort of land constriction. You fly into Vegas and it looks like you can build and build forever, but a lot of that land isn't necessarily available today. So how are you, one, navigating finding parcels to actually build on? And two, I think what everyone kind of knows to be true today is you have this on again, off again, start and stop with tariff policy that reflects construction costs and ultimately impacts your budgets and pricing and things like that. So it's a twofold question, but how are you navigating those two challenges in today's market?
Yeah, the tariff concerns is a very real concern that thankfully we have a head of construction. If Martin Harris or anyone on the construction field probably knows our head of construction, who's very, very thoughtful. And I think the work that you guys collectively are doing with our head of construction is incredibly helpful to candidly just keeping sort of a ceiling on the total escalation that we're facing. But it is real. It is making these projects less economically viable. And candidly, we're having to be much more thoughtful around where we source different materials and supplies. And, we used to procure certain things internationally that we need to switch countries because of the tariff policies are capping our ability to source from the same price. And our goal ultimately is to deliver quality product to serve, the communities that we're in. And it's just becoming significantly harder. The land availability, as you sort of answered your own question, is a great consideration that candidly has resulted in us as a company spending significantly more time in other markets, because there's only so much land that's available for sale that we can build multifamily. So sometimes there's a zoning consideration that may limit the amount of density that we need to kind of bring a project to life within a certain area. But oftentimes it's just lack of land that's kind of ripe for multifamily development. So, we think that there's 10 to 15 years of good development left, but we're spending a lot of time in other markets just to, candidly source a pipeline within markets that don't necessarily have the same constraints or, national reserves on the periphery that are really kind of limiting our developable area. Mm-hmm. But I think having these discussions are important because, again, there are certain things that kind of we can do thoughtfully as a community together to ultimately provide more housing. I don't know if we're going to get into this, but there are a couple times, I don't want to misspeak, but there have been quite a few bills that have been sort of proposed to provide affordable housing provisions that were, originally intended to serve the community that they were, created to serve. And by creating a bunch of, call it, additional limitations or constraints on developers to build product, that's ultimately just going to be contrarian to, delivering housing that we're intending to deliver.
Yeah, we'll get into that in a little bit later. But yeah, essentially adding more supply is actually, as we're seeing right now, puts downward pressure on rents. It's a simple supply and demand metric. If you start to cap or limit the amount of new developments in any given market, rents shoot up as a product of demand. So we'll get into that in a second. But let's get into, Ed, we're going to talk about acquisitions of existing product, value add, something that I know all too well has been very quiet for the last 2.5 years. To put some numbers to that, on my side of the business, there's about 55 projects that trade per year from a sales volume perspective, over 100 units. That's what we focus on here. In 2021, there was 84 that traded hands. In 2022, it was 51. That was all very front-loaded in the first half of the year. 2023, there were 7. We did 2 of them, which is number 1 market share. But in 2024, there was 28 market-wide. And year-to-date, 2025, there's only been 10. So there's only been 45 in the last 3 years. So the opportunities aren't as prevalent as they normally are in a normal market. But where are you finding opportunities today? What is your ultimate buy box or acquisition criteria for the market in Vegas?
Yeah, those are all good points. So traditionally, we're value-add guys, right? We buy sort of 90s plus. We own some 80s stuff too, where we can, what we do is affordable with a small a, right? We're not government subsidized affordable, but it's affordable housing with a small a. So we can go in, we can renovate, we can spend anywhere from maybe $5,000 to $15,000 a door, renovate to a very nice spec for the resident and give them a great value product, right? Compared to a new build, which is going to be a lot more expensive, obviously. And most of our residents, I say they're residents by necessity, not by choice, right? Most of our tenants, a lot of them probably won't ever own a home, and especially now with where interest rates are, right? So it's gotten harder and harder. That gap continues to get wider, right? So in looking at deals today, opportunities, to your point, there's very few of them. When they do come up, surprisingly, there's a ton of investor demand still, right? 20, 30 offers you'll see on a deal. And maybe the deals maybe they don't, right? Because financing comes into play and everything else. But I guess it's harder to underwrite deals today because when you're in a market that has flat or declining rents, and at the same time, our operational expenses have been rising, right? With insurance costs are up, I think, 40% over the last 5 years. Material costs, payroll costs, they've all gone up, right? So everyone's NOI margins have compressed. And so, it's hard to underwrite into sort of that market. You have to have some optimism and rent growth. And Shawn and I were talking earlier, we think rent growth will come back to Vegas probably 26, 27, we're hoping, where we'll be positive again. So, yeah, it's harder to underwrite. It's still very competitive. Everyone seeks positive leverage, right? So when you see rates where they are today, I mean, we're more conservative, lower leverage agency debt guys. And I think, we can buy down a 10-year Fannie loan, low 5 handle today, mid-5, low to mid-5s probably, depending on where the 10-year is today. And so, and cap rates are sort of in that range, right? So they're sort of right on top of each other. So it's hard to get positive leverage. You have to be optimistic in your rent growth projections, which is what it's all about, right? For guys like us that underwrite, like who has, what are your assumptions, right, that we always look at.
So when he refers to positive leverage, it's essentially the equation of what is your going in cap rate. Say it's 5.5, relative to your today's cost of debt on your interest rate, which is, call it 5.25. That 25 basis point spread is positive leverage. Negative leverage would be the opposite. Neutral leverage is where they're in line.
And so, I'll just continue. So where we are seeing opportunities today is, it's kind of, to me, it's two different markets right now. You have the existing owners, anyone who refinanced during the COVID era has low fixed rate debt. They're not sellers. They're going to wait it out, and that's our portfolio, right? We're not going to sell in this environment today because we don't have to. Guys that got over their skis in 21, 22, and there's a lot of them. A lot of those guys would like to be sellers, but they're over leveraged. And so unlike 08, when I came into this market, we're not seeing distress. And we've been talking about distress for a couple of years now. It's going to play out. So far, lenders, for various reasons, have chosen to sort of kick that can and work to modify deals out and bring pref in or whatever they need to do to work it out, right? So we're not seeing a lot of distress, but we are interested in seeing opportunities on new build stuff where developers are either having a tougher time leasing up because they're giving concessions, and now, maybe they're leased up, maybe they're mid-lease up, their construction loan's coming due, and they can't get a takeout, right, because of financing. And so those guys are willing to sort of sell, in some cases below replacement of what it would cost to rebuild that exact site today. So we're seeing some of that on multifamily and a lot of it in the B to R space. Not as much here, but other places, on B to R especially.
Yeah, I think the distress conversation is something that everyone's been waiting for, but just hasn't necessarily materialized. I think if the sponsor is still playing ball and trying to work the deal, I think there's a general belief in both the Vegas market and the multifamily as an inherent asset class that it's never going to be obsolete. People always need some place to live. So, I think there's a belief that we can get to that rent growth of 26, 27. You can kick the can down the road, but that distress part is.
And I think there might be belief that rates are going to come down and save some of these deals anyways, right?
Yes.
That's been the hope.
Yep, for the last couple of years now.
Yeah.
So, distress was my next question.
Oh, sorry.
But I think one thing that's interesting from the acquisition side, and it seems like 90% of the buyer pool, they want to be in assets that are built in 2000 or newer, right? I just think there's a general belief and a general flight to quality for product and location.
Yes.
Do you feel there's opportunity in the deals that are outside of the buy box today, the 70s, 80s, workforce product, or is it just not there yet?
I think there are, but I think there's a lot more risk to those deals today, right? Like I mentioned earlier, a lot of the fraud that we're seeing, the quality of tenant, there's definitely a drop-off typically between a 2000 build and a 1970s asset. And then on top of it, your operational expenses of running a 1970s building go way up, right, with cost of repairs and having to replace
capital events, roofs, HVAC,
all that stuff, right?
Lots.
And if you're not growing your rents out of that, it's a tough sell.
Yeah. So I think what we're seeing on our side, because we get a lot of listings of 80s product today, and it just doesn't seem to be the flavor of the month, but there just needs to be some sort of yield incentivization that I think sellers of those product are not willing to dip to on a cap rate.
I think once we see rents going up, those deals will move again.
Yeah.
And it's interesting because I always said, what we do, we're very insulated from new development, and we are to a certain extent, but when you have such the great amount of supply, that's been delivered to this market across the country, there is a dilution effect, right? I mean, it does, because, new developers have to lease up, right? So they're willing to give concessions, of a month, 2 months. We've seen a lot of extreme concessions. And so even though, typically a lot of our renters couldn't afford, the C guy can now move up to the B moves up to the A, and so you have this sort of dilution effect across the market, which keeps rents down, to your earlier point. So we need supply, right? If we're really going to keep an affordable market.
Agreed. Well, let's go back to supply and let's just talk about what's actually being built as it relates to product type, locations, things like that. Shawn, we've seen, historically, garden style apartments has been Vegas's bread and butter. And when I say garden style, that's stick frame, right? 2 or 3 stories, maybe sometimes 4, but generally not elevator served, service level parking. The stuff you drive around and see all over town. That's always been what's been the most common construction type here. Now you're starting to see higher density, higher cost of construction, more infill, tighter sites as it relates to wrap, which is structured parking garage, podium, which is stick over a floor of concrete or steel. And now you're actually seeing a high-rise, steel and glass being built in Symphony Park, 22 stories, pure rental product. So what do you think is driving this shift to more expensive and more, higher cost of construction and ultimately higher rent product in the market and skewing away from that more kind of bread and butter garden style stuff?
So you are right. If you look at the stock of all apartments in Clark County, just the raw stock, 80% as a whole as we speak would be classified as garden style low rise. That's not actually true right now. So if you look at what's been developed over the past 4 years, the share of garden style low rise has fell to 40% of all stock being developed. But before you get to sort of explanations, which is really in their lane more than mine, I think there's a bigger story about demographic shifts as it relates to the sort of garden style cap rate phenomenon. So in terms of historical context, historically, cap rates generally higher for garden style low rise across basically the entire course of real estate history. And that shifted and changed for the first time in real estate history in 2022, when cap rates again for garden style low rise fell below mid-rise, high-rise, first time as we knew it. And economists were thinking like, well, what's going on here? You guys would know more than I would, but what first thing we looked at was what markets had the highest share of those low-rise units. And the answer is markets in Sun Belt metros, right? And so the next thing you would do is look towards population growth. And the first thing we found is that if you look at existing population growth across that Sun Belt metro area, it's exceeding that of non-Sun Belt regions by 3.5 times. But what's even more interesting is if you take that same part of the sample, Sun Belt regions across the United States, projected population growth for those regions right now over the next decade is 22 times higher than it will be for the remaining part of the U.S. You toss in rising operational expenses, coastal flood risk in Florida, potential risks in Houston and the Gulf, and then all of a sudden, attention on markets like Vegas and Phoenix become sort of interesting. But again, deferring to the guys that actually build these things, the economics tell me that there's some economies to adding another floor and getting you out of that garden style low-rise segment back into that mid-rise segment, driving that 80 to 40% sort of shift that we're seeing. And again, I'll turn to you, Josh. I mean, about really what's causing that shift and that, again, that rise in mid-rise property seeing in Southern Nevada.
I mean, it all comes down to just what's the highest and best use for that parcel. So, I mean, rather than build the product that we think we would like to build, we're ultimately looking at each parcel as what we can build, what economically makes sense for that area. So sometimes there are limitations around densities or single family adjacencies that kind of cap what you can actually build. So there's a lot of, anytime that something's more urban, land becomes a lot more scarce. You're having to build much higher density product. And when the peripheries start to no longer make sense because land price is still too high on a, everyone has a different perspective on this, but still too high to develop multifamily, then people start looking at, can I build additional density to justify the higher land price? Or can I actually get the rents that I need to achieve to ultimately spend more money in the actual product type? So, when you move from 3-story to 4-story, there's a cost differential. When you move to 4-story to 5-story, there's a much greater cost differential. When you layer in the land, then that ultimately kind of backs into what you can build. So we try to be as thoughtful as possible. We spend a ton of time site planning, but ultimately the cost of the land and the cost to build and just the rents that you can achieve ultimately dictates kind of what we end up designing and building.
And there's another part of this story that we don't really talk about because no one's ever actually run the data. How much multifamily is really being built in terms of land utilized in Southern Nevada. Never been studied before. And so we went to the Clark County assessor. Thank you if you're here in the audience. We really appreciate you, which gave us FTP access to the universe of property in Clark County. Every single record, every single parcel, all 875,000 parcels sit on my computer. And I could track over the entire course of Nevada's history exactly what's been built down to a sidewalk, when it was built, and how much land was utilized for it. So we thought, well, let's just find out how much of all residentially developed land currently has been prioritized for single-family development. The answer, exactly down to the decimal, 90.74% of our land for single-family. So what's even more interesting is, well, look, let's look at 1995 to present day and ask how much more land acreage is being absorbed, used, for single-family relative to multifamily. The answer, 1,484.11%. 1,400% more land being used for single-family than multifamily. And coincidentally, going back to your point about density, bang for your acre, bang for your buck in terms of acre, irrespective of zoning, if we actually look at the actual units of multifamily on land, 218% more units are fitting on our land acreage relative to single-family use. So when we have conversations like things about rent control and rent stabilization and all these things and concerns about the rental market, team, it is a miracle that you're even having apartments affordable to the workforce housing segment, let alone anyone. It's a miracle. No, it's an economic miracle given that gap in development. No other major metro that I know of in the United States has that delta between single-family and multifamily development. So how does it work? And the answer is, we might have been lucky.
We'll take it. We'll take it. So I think one thing, Josh, that you guys are doing to bridge that gap, and I think it's a phenomenal trend and phenomenal product type that's not happening as much in Vegas as you see in other Sunbelt markets, but I think it's a great opportunity. I won't answer my own question, but you guys are building BTR, and what we call BTR is build to rent product, which is, I always thought was funny because everything on multifamily is built to rent. But essentially what it is single family homes for rent, contiguous communities, whether it's townhomes or it's separate, detached 2-story homes with a backyard and a driveway and a garage, right? So it's all built for the people that can't, well, what is contributing to the BTR segment of the population, and where are you seeing opportunities there, and why do you guys like that space?
Yeah, so there's sort of a BTR segment that gets looped into just SFR, which is just single family rentals. So these have completely detached, detached buildings, true sidewalks. They're on their own separate parcel. So the BTR space has been built within the Southwest as a whole. There's tens of thousands of units that have been built within the last 5 years in Phoenix, but there are less than 5 or 6 true BTR deals that have been built within Las Vegas, and that's because it's super expensive to buy land here, and for the places that you can buy land, oftentimes you're not necessarily hitting the rents that you need to hit. So we love the product. We think that there's like a very important kind of product type fit within Vegas. From a consumer that used to live in an apartment, still wants, some of the luxuries of having a clubhouse that they can hang out with friends in. They have, a ton of, if there's a light bulb that ends up, shutting off, we're coming in to, screw in a light bulb and provide new filters and do all the things that make single family home ownership just frustrating. So I think it's a very interesting segment, but just because of, pricing and the cost to build it, it's a very challenging segment to deliver. So we have a great new community in Cadence that We should be opening up in the next couple months. But again, there's been less than 10 built while Phoenix is building, tens of thousands of units.
Yeah. I think it alludes to what we talked about earlier, just unaffordability of the single-family home market,
Yes.
people able to virtually achieve that lifestyle of living. And, we are in a business that is it's the people business, right? You're dealing with people's lives in multifamily, and whether or not we can build the right product and, given the tariffs and the land and everything, people's lives still go on. Their families get bigger, they get a dog, they need more space, right? They need roommates, things like that. So I think BTR really fills that gap for a shifting demographic, that, first-time home buyers that are priced out of the market today. So I'd love to see more than that, but there's obviously challenges associated with that. We are coming up to
Can I
the,
add on that?
yes, please.
Because we're in escrow, we're buying one right now, BTR deal. It's outside of Phoenix, and to your point, Josh, right, it's got, we're seeing more tertiary markets for that development because of land costs. But yeah, to me, it comes down to affordability, right? I mean, we have these families now that can live in a true single-family home. The property we're buying has 2-car attached garage in a real neighborhood with sidewalks, and I think the affordability issue is huge, and young families starting out, that gap has gotten pretty wide, so it's a nice alternative for them to live in a brand new single-family home, and these homes rent for, average just over $2,000 a month, right?
Yeah.
And so, much more affordable than buying, not to mention you need a down payment to buy and closing costs, et cetera. So I think it's a good alternative.
And it comes with the maintenance, right?
Correct.
It's professionally managed
Yes.
maintenance. You don't have to go through and 10 years after you buy, renovate your kitchen, which we're going through right now, which is, shout out to my parents for letting us stay with them. But I think we're coming up to the top of the hour here. I think there's a Q&A segment that we wanted to, if there is any.
We do have a couple questions here, and then if there's only a couple, you should finish, because I know you have a lot of them. Let me start maybe with Josh. Would it be helpful if Clark County used the high-rise definition in the building code as opposed to limiting it to 55 feet high? Is that something you can
I
touch?
feel like that's a question about whether or no IBC cold.
It's in the
So,
weeds,
which
but
the
it's,
answer is unfortunately not. So I think the answer is yes. There are minor things that other cities do regarding setting the finished floor elevation. So anytime that you have a ton of topography, you have one side of your parcel that's much higher than the other, creating like a more lenient way of kind of artificially setting what that kind of finished floor elevation is incredibly helpful. But at the end of the day, there's IBC, the building code for multifamily builders, ultimately will become significantly more expensive the higher up you go. So I think there are a lot of things that we can kind of do in the margins that actually have a demonstrable impact into making it more affordable to build. Also, there's ultimately investors behind each deal that we build, and investors want to be paid a certain return, and then they also want to be paid a certain return within a certain time frame. So anything that we can do from a policy standpoint to truncate the actual timeline of reviewing permits or entitlements, it actually does have a demonstrable effect to making, candidly, some of these deals that are not financeable today more financeable.
thank you. This could be another question for you. I think there's a couple for you. But in new development, where does land need to be priced in today's cost of a construction and rents? It's a general question, but
Yeah, I think, it's all dependent on the location. So
maybe give us a range of some of your in-town stuff. I know you don't want to play your whole card, because
yeah, we bought a piece of land that's directly adjacent to the Durango Casino, and we're building 398 units. It's fully financed. We should be starting construction within days. I think we paid $1.2 million an acre for that. It was a great buy.
It's actually not bad.
But then, I worked on it for 10 years. So, but then there are other parts of town where, Landowner owns a property, in sort of South Henderson, and in 2022, there were a bunch of developers telling him that their land's essentially worth $2 million an acre. And just today, out-of-state groups will take a look at the land, will spend a bunch of time, but won't actually buy the land because we know it's not economically viable, given investors that we have relationships with who are kind of just scouring for information. So typically, the single-family guys are willing to pay more than the multifamily guys, which was not the case for a 10-year period of time, but today it's almost inverse. But a lot of softness within the single-family segment is actually resulting in a lot of the single-family groups kind of decreasing their pricing. So they were topping out at $1.5 million an acre for good dirt, and now they're probably closer to the 1.1 to 1.3 for good dirt, and then if you're main and main within Summerlin, they're still paying high ones.
Thank you. Shawn, does the rate of renters leaving their units to buy a home significantly impact the 10-year projection of new units needed? Or is the assumption they'll stay there forever? It was touched on a little bit of them staying. Ed mentioned it, but what's your thoughts on that?
Does the rate at which renters stay in their property?
That they go on to, they move up and they buy a house. Is that a projection that you use?
It's a number I don't know. Yeah, it's a good question, though. Yeah, happy to look into that one.
I mean, I can add one comment on that. In my opinion, we're seeing more, like I mentioned earlier, in the workforce space, we have renters by necessity, not by choice. But having said that, we're also seeing a lot more renters by choice, right? As you look at the younger generation coming up, a lot of them want freedom, flexibility. They don't want to be tied down with house payments. They're happy renting, Josh's new stuff, right? And at the same time, you have aging baby boomers who maybe cash out of their home and they're like, we don't need the hassle of another home. We're going to rent and drive the country into Winnebago, right? So, and then, not to be political about immigration, but, immigration coming in legally, that's going to grow our country too. And they're always, immigrants coming to this country are renters for at least the first 5 years. So we have these new drivers sort of continued demand. And a lot of those people, to your point, we say like, is the U.S. becoming a renter nation? I mean, maybe, I think more people are choosing to rent.
And the stat is delicate. Talking about an individual person renting and moving out, a little different than thinking about shifts in the renter household population. So that we do track. And when you do look at that number, the rate of household growth amongst renter households is more than double the rate of household growth amongst owner-occupied households. So again, that is unclear if it's a population trend or if it has more to do with that tenure in a unit. Again, very delicate point, but there may be something to it.
And Josh, could you expand on who your tenant is? They're not, because they need to, all of them, because you're higher rents.
Yeah. In certain parts of, in certain pockets of town where it's actually, it's affluent neighborhoods, we're noticing a lot of our tenants are candidly potentially here today. So, I mean, several of my VPs live in our properties and, could easily afford to buy a house and make great money, and they choose to live there for convenience. In one of our properties, we had, I think this is fine sharing. If not, you guys can cut the clip, But in one of our communities, we had an average household income of $200,000 per unit. And these units are smaller, so typically you're saying if it's a 2-bed, 2-bath, it's more likely $250,000, $300,000. So what's interesting is, this is only a few communities in town, high amenitized. Oftentimes it's serving a demographic that candidly, really wants to live for a certain period of time. They're building their home in the ridges and want to live within a certain pocket. And there's really only one or two communities that they're willing to live in. And then we have other properties that are probably within the 80 to 120, 130% of AMI range.
Not a lot of TikTok fraud?
I had a question on that. When you talk about, you have these high earners at certain properties and you have this lifestyle renter demographic, what is the ultimate lifestyle that you're building for these folks as it relates to amenities? I think in my experience, it's always been pools and gyms are what get people in the door. You've seen people try out podcast studios and co-working things and restaurants and bars. And so what do you think ultimately is the most down the middle deliverable amenity set for the people at that higher earning spectrum?
I think there's the down the middle amenity set, which is boutique seating areas and what feels like very well kind of orchestrated FF&E, well designed product.
FF&E is furnitures, fixtures, and equipment.
Yeah, sorry. So creating spaces that people actually want to spend time, I think, is the most important thing. So it's completely overlooked. People space plan, they put chairs on the ground, they put a rug on the ground, but it's not necessarily where tenants will actually spend time. But we try to create spaces where people can actually build communities. So it's incredibly important. We spend a ton of time just making sure that we have different group settings for areas that people can connect, whether it's, two friends that are just going to wait by, for an Uber just outside of the clubhouse, or it's a foursome tabletop where people can share a meal, or an 8-person group where people can have a bunch of friends. But figuring out kind of that right is super important. And then you have the standard amenities, which are, nice clubhouse. You have, a billiards table. You have a nice gym. But then in some of our communities, we have a much greater emphasis and focus on health and wellness. So we'll end up having, in some of our old properties, we had tanning and massage rooms. In some of our newer properties, we have red light rooms, which is definitely more PC today than tanning. So that's sort of, in a nutshell.
And tying what he's saying into a sort of classic story of urban economics, very difficult for a metro to see really solid growth without having a really nice balance of rental property and single-family property. And it's not what you think. A lot of people think, well, you want cheap rents to save money, to buy into a home. It's not really that. What it really comes down to in terms of just a core economic theory, something called labor mobility. Someone who's young in their career, their ability to move around frequently to find that best fit with that best job and grow their skill set and earn that money young to position themselves to buy a home is contingent upon a market having a robust rental segment. And this is why metros generally suffer when they don't have a nice mix of land use across the spectrum.
I like it.
The four of you have different perspectives on the same market. What is your views, and you can all answer or talk amongst yourselves, on rent control?
Yeah, let's get political. Let's get political.
I think rent control is a horrible idea. I live in California, and I think most people in this room understand this, demand, supply, basic economics, and to our earlier points, right? Like affordability, is it an issue here and in the country? Yes, absolutely it is. How do you solve for that? Do you constrict supply, right, by having rent control? When you have rent control, now all of a sudden you have developers that don't want to come into that market and build. You have existing owners that don't want to put more money into the properties, right? And so you have this weird effect, and at the same time, you have a resident base that oftentimes, like in Santa Monica, they'll game the system, and you create this whole black market of renters that don't even live there and own a house somewhere and are renting to this guy that's been there, 30 years or taking over their lease. So, in my opinion, it's a bad idea. It does not work for those reasons. We need to make it easier to build and increase supply.
I don't think we're going to have different opinions on this across the panel here, but yeah, I think ultimately we're not up here trying to say we want rents to be as high as possible for our own interest. It's really just you'll have dilapidated housing, as Ed mentioned. It's essentially a failed provision, and it sounds good on paper and
Yes.
mostly to voters, but it ultimately when you actually put it into play, it's really bad for the housing market and ultimately ends up making it more expensive.
Yes.
Adam, do you want to take us out with some
please.
remaining questions you have?
Sure. Well, I was going to talk about rent control, but I think just lightning round, whoever wants it first. What do you feel is the biggest opportunity in Southern Nevada multifamily over the next 5 to 10 years?
I think you can buy now at valuations that are much more reasonable than we saw 3 years ago. And I think it's a nice entry point today, even though, what I would say is maybe you're buying into a little bit of pain for a year or so until that supply wave sort of crashes down and rents start going up again. But I think today's a good entry point to get back into Las Vegas and start buying.
I think it's just population growth. I mean, population growth based on Shawn's statistics, all the research that we do internally show that there are really a handful of states across the country that are benefiting from continued population growth. It's been a 30-year trend, and it's expected to continue. So I think that's really driving the demand for additional housing, and multifamily gets to kind of benefit from some of that pent-up demand.
And broadly, all signs and arrows are pointing to the word up. I mean, at least in the long term. And so we have every opportunity to get there and to become a really big, powerful MSA. And how we get there will be housing. When we think about economics, real estate is the greatest equalizer in the modern economy. When we talk about econ dev, bringing in new industry and new jobs, what that is synonymous with is bringing in new people. And when you bring in new people, you increase the supply of demanders for renters and housing units. So if you bring in new industry, you bring in more people, it puts upward pressure on prices and rents, which can wash out some of those sorting dynamics and offset some of those econ dev gains. So the good old times of thinking about econ dev and real estate as sort of separate disciplines are long over. The idea of bringing real estate first in paramount, at prime importance with economic development stories is literally right now. Because that's exactly how you will get and reap the actual net benefits of job growth and wage growth.
Very nice. And then this next one, they wanted me to ask. I didn't write it. It says, who is your favorite multifamily broker in Las Vegas? Jessica. All right.
Adam Schmidt.
Thank you. That's right. Thank you, Ed. I will show you off-market deals.
Thank you.
Ending this with...
I started my career at CBRE, by the way.
Is that right?
For the record.
So
there you
Josh
go.
was there for a little bit,
Right,
cup of
all right.
coffee. Ending with, we'll try to end this on some inspiration. So, and I don't know if Owen Sherwood's here, but I stole this from him on a panel that we did 5 years ago or so. The question he asked was what is the best career advice you've ever received? And I'll go first because I already know my answer because I have the question. But I don't know if anyone knows my partner, Spence Balliff, my partner at work. He and I have been partners for 10 years now. He was my mentor, getting through the business. And I started in 2016, which is it was gangbusters from then until COVID. And when COVID hit, I was trying to understand, what was happening in the market. Obviously, commission-based, you don't make any money in those years. And I remember calling Spence and pacing the house, right? It's mid-June, the strip shut down. There's 34% unemployment. I haven't had a haircut in 2.5 months. I said, Spence, well, what the hell are we going to do? Like, how does this ever get better? What, do we go play golf? Do we vacation where we can? He goes, Adam, this is the moment where you earn your money. These are the markets where you make decisions for your clients, be a trusted advisor for them. And when the time comes, when the market's better, they're going to remember you had their best interest out for them in the bad times. So the money is made in the down years, and not actually, but you realize it when the market actually bounces back. So I've always found that to be pretty good advice.
I would say the best business advice is being open, honest, and truthful. It's a small industry, it's a small business. The truth always comes out. We all make mistakes, things happen, and I'm always big in our company, like, you got to raise your hand if you make a mistake and own it, right? And people will forgive you if you make a mistake. But if you try to bury and hide and lie, that creates bigger problems down the road, and ultimately it gets found out. So, it's the old thing of being honest and truthful. That's the best business advice.
Good piece of advice. My advisor told me, don't forget every talk is a job talk. I never forgot that one. But being more serious, taking stock that I'm not an investor or developer, I'm a researcher. I remember Jeff Lepore at one of these talks said, we build for tomorrow, not for today, which I thought was just an amazingly powerful thing to say. And it resonated with me because when we do research as scientists, we research for tomorrow, not always today. And so we're thinking about the market and thinking about what's going on. I think that sort of inspires me to not just look at sort of what's happening in the market right now. That has a place. but thinking about where might we be in 10 years with 388,000 more people, and wait till we hit 3 million, will have an implication for what we do now, even though it's happening down the road.
For me, it's just been, demonstrate integrity at every single point. People have long memories, and if you've lived like a very good life and have one bad experience where you do something unethically with someone, they're going to remember it, and just the world's a lot smaller than people realize.
Well, we're right on time to close it out. Thank you all for being here today. Appreciate you taking the time. I want to thank the panelists, Ed Aloe, Dr. Shawn McCoy, and Josh Nelson. I think that was a great conversation. So enjoy the rest of your day.
Thank you so much to our great panel today. Thanks again to our speakers, our breakfast meeting sponsor, Panetone Development Company, and to all of you for attending this morning. Hope to see you again here at the Orleans on September 18th for our next breakfast program. Have a good day.